Hey, welcome to Coffee Dreamin', the show where sales, marketing, and operations folks come to sharpen their edge and build smarter, more resilient careers. I'm your host, Royce Hall, Salesforce consultant by day and podcaster by night. In this episode, I'm joined by JP Albano, a former enterprise B2B sales exec who unlocked the golden handcuffs of his career with real estate investing. After 15 years in IT sales, JP made the leap into multifamily real estate investing and now helps high income sellers escape burnout, lower their tax burden, and build passive income through apartment syndication. If you're interested in building true generational wealth, stay tuned and check out JP's free offer for you. JP, you and I met a while ago, and anybody watching this video and not just listening to it can see your book in the background. So Rich, You Can Quit. Tell us about what you're doing over there.
Yes, thank you. So, having been in tech sales for 15 years and selling a lot of tech sales gear, I realized quite a long time ago, and I'm sure many of your Salesforce listeners or anyone that's in sales and earning a good income, especially when you get north of 200, 300K, you start noticing a lot of your money goes into taxes. And for me, it sort of hit a breaking point where I was just honestly tired of seeing 30, 40, almost feeling like 50% of my hard-earned money going right out the window. And after a few years of that, I just got to a point where, like, especially where I was saving up, I had just become a sales guy. I was a sales engineer before that, and I had a lot riding on this new career transition, right? My wife was staying at home, take care of our growing family. We had a second baby on the way. We were outgrowing our house that we were renting, and our landlords were being jerks and wanted to kick us out, sort of thing. Not because we were bad, just like they wanted us to sell the property. And we were like, well, we need to get a house. So I had a big sale that I closed. I was waiting for the commission to come in for that. It was, at the time, my biggest commission check was like 50K or so I was expecting. I remember getting that check because I was going to use it for a down payment. Got the check, and I was still getting a physical pay stub at the time, right? So you get open it up, the envelope, you're looking at it, you look at the dollar amount, and I'm like staring at it, and I'm like, it didn't make sense. Like, and I was really confused. And I felt like an eternity searching around the whole sheet of paper, trying to understand what was going on here. And I'm looking around, and it finally made sense to me. I look at the gross income. It was one number, and then the bottom number was like 40% less. And I looked at taxes withheld. And that's where the answer was, withheld taxes. And it really set me back on that, but it inspired me to figure out, how the hell do I escape this craziness? How do other people do it? And it led me down a whole journey. We can get into that journey, but it led me down a journey of trying to just figure out, how do I escape these high taxes? And I think I figured it out.
Yeah. Well, I'd love to hear more about that. And I think about like Robert Kiyosaki, Rich Dad, Poor Dad. And like, that's his whole thing is like, this is, I think, aside from politics, like whatever side of the coin you fall on politics, yeah. Like, can you pay less taxes? Yes, you can. Yeah. And how do you keep more of that hard-earned income and make, I think, generational wealth, for your family?
Exactly.
And go for it, JP.
Yeah, I what I've noticed recently, or realized recently, is I don't think it's that concept what you just brought on, generational wealth. I don't think it's as out of reach as many of us normal people think it is. Right? Maybe we just kind of think that's for the ultra wealthy, right? That's not me, that's them. You got to have hundreds of millions of dollars. And yes, for a long time that was the case. I think now with the more mainstreamism, if that's even a word, of private real estate syndications, of just different strategies, learning about these tax strategies, number one, and really leveraging, if you will, what high income sales earners can do for creating that generational wealth. Like, maybe some, we'll call it budgeting discipline, right? Getting into the habit of living off of your base, if you have a base, and being very diligent in what you do with your commissions, and putting it in things that's going to grow in a tax advantage way. And for me, I fell in love with real estate investing. We can get into that. But like, for me, that's a big piece of the puzzle, is being able to put my money in this thing that cash flows, and take that cash flow and reinvest into another deal and let that thing snowball for a good 5, 7, 10 plus years. Like, this isn't an overnight get rich quick sort of thing, but slow and steady wins the waste. And it gets to a point where at some point in the future, depending on how much you're putting away, you get to a point where you can get all your needs, your basic needs, like your mortgage and your car payment and your utility bills, your groceries, or even a portion of that paid for by cash flow from assets that are paying you. And like when you get to that point where you at least you can put food on the table and you got a roof over the head to provide for your family, like that's a level of comfort and peace that is attainable, number one, and it's a game changer for anyone that's working for trading their time for money.
So let me ask you something. Like I've read your book. I appreciate you sending that to me. Aside from getting your book on Amazon, what can people? How can people interact with you? Like, what do you have for us?
I appreciate that. So I actually have a special gift for your listeners. If you check out my website, jpalbano.com/gift, and I'll give you the link so you can email out there. You can get a free copy of my book. Just cover shipping and handling, and I will rush you out a free copy of my book, put it in your hands. And the purpose of the book is really just to get you to understand, not get you to understand, but help you understand the power that you have as a high earning income seller, right? Like getting to a point of financial freedom isn't as far away as you think. You just need someone to show you the way, show you how to escape this time for money paradigm, how to escape this crazy tax. Because I tell you what, if you're just realizing this now, your tax situation will frankly never go away. It just won't. So if you're making $200,000-300,000 now and you got a great pipeline and you're looking to get to $500,000, it's only going to get worse. Because once you crest, I think it's $500,000 or $600,000. I spend a lot of time looking at real estate tax brackets, by the way. Once you get over a certain amount, you're taxed at 37%. So every dollar from that point on is almost 40% right out the window. And you get to a point where, you're basically working 40%, 40 cents every dollar goes out the window in taxes, but that's neither here nor there. Go to my website, jpalbano.com/gift, and you get a free copy of my book. And I lay it all out for you, get you excited about that. And then ultimately my job is I have a sneaky plan. I have a Grandmaster Muha plan. So I run a tech sales investor club, right? Now, honestly, it's open to anybody, but I cater to tech sales people. In the club, I teach you more about the things that I read about, talk about in the book, but more importantly, I get you access to the deals that allow you to reach that financial freedom. So I make a turnkey solution for you, get you excited about investing in real estate, teach you about the tax advantages, teach you about real estate so you're comfortable investing in deals. And then I get you access to pre-screen and pre-vet deals that we do inside of our club. So that's ultimately where the book takes you to, Royce. But I feel like it's a good spoiler alert to let people know what's coming after the book.
Yeah, well, I love that. You're giving us the vision and also access to the vision, right?
Correct.
So it's not just you need to go do this. Like,
we'll figure it out. Go ahead, figure it out.
Yeah, you're helping us actually invest and do it. So let me ask you something then. So the grand plan behind this, you've already alluded to it. You're in real estate investing. That's like the main driver, and it's more granular than that. That's not just like I'm gonna go buy a house, right? That's much more than that. So. Can you give me a little bit more than that? And also, like, why this versus, like, let's put it in the Roth, in the 401k. Let's get into day trading. Like, why this?
It's a great question. And I think the best way to answer the question with a little bit of a story. So when I had that heartbreaking moment that I described in the beginning about the tax, the bill, my paycheck, and realizing, man, I'm in this tax game that I'm never going to escape, I started figuring out how am I going to get out of this. And what I learned was that the problem is the way we earn money, right? W-2 income, active income, ordinary income is subject to the highest tax rates, period, here in the United States. There are other ways of making income that aren't subject to ordinary income, right? Those tax brackets we talked about. So earning money through capital gains, typically, passive income through stock market, day trading or stock markets or real estate investing are categorized as capital gains. Capital gains is a much lower potential maximum tax rate. So max 20% versus 37% on the federal side. It's almost half, depending on long-term, short-term, whatever. We're not getting into that. So I'm like, oh, cool. If I do some day trading, I could take my money from sales, put it in the market, trade it a little bit, make some money that's taxed less. It's the way to do it. Well, turns out day trading is hard. I took a course. And I spent a lot of time. I learned how to read candlestick charts, and I learned a couple things. One, I'm not good at it. Two, it's more stressful than being in sales. And number three, more importantly, I realized, you know what, I'm doing the wrong thing. What I'm doing is I'm still trading my time for money. That's what I'm doing in sales. That's what I'm doing in day trading, but yet I'm paying less in taxes on the money they make. What I really want is I want passive income. I don't want to keep selling hard drives. In my case, I sold a lot of for the rest of my life. So what can I do that makes passive income that's taxed at the capital gains rate? And real estate was the answer. It still is the answer. The problem that you alluded to is, okay, well, where in real estate? You read Rich Dad, Poor Dad from Robert Kiyosaki. Great book. It's like everyone that comes into real estate investing has to read that book. And there's like 1,000 different ways that you can get involved in real estate. You can do wholesaling. I'm not going to get to that. You can do fix and flipping. You could get an Airbnb. You can do a single family rental. I've had that. So you can do note investing. There's a lot of different things, all overwhelming. For me, what made the most sense was I liked the concept of renting, right? But I didn't want to have one tenant. I wanted lots of tenants. The more, the merrier. So like I had a single family rental. It didn't work out so great. When they don't pay their rent 1 month, like the amount of profit you make kind of goes out the window real fast. So I read this book early on called Emerging Markets by Dave Lindahl. And I read it cover to cover, and I was inspired by the business model of multifamily apartments. So to me, an apartment complex with 100 units makes the most sense because you've got all this risk mitigation by having lots of different families paying your rent each month that you then use to pay the mortgage for the property. So they're building equity for you. And if you play your cards right, there's cash flow and things like that. So for me, multifamily was the vehicle, and we built a business. We built a business where we acquired 700 apartment units over time. And we've shifted our business a little bit. And now we focus on finding really good operators and really good deals. But having done that for a number of years, 7 or 8 years or so, gave us a lot of experience and a lot of just understanding of how that industry works. And now we use it to our advantage to help find and screen these sponsors that do that way better than we ever could. Like tens of thousands of units versus 700.
Yeah.
Sort of.
So then that must mean that you fix toilets full time then.
Yeah, not anymore. So, that was part of it, right? When we, in the beginning, when we got started with that, going door to door, picking up rent, we had a 60 unit in Atlanta. Our property manager that we had quit. And, as the operator, as the owner, guess where the responsibility, falls onto? And this is a good illustration because you asked about what other real estate, right? A common mistake I see with sellers or anybody that gets into investing is they see, they see the YouTube thing, they hear the podcast about it, they're excited about it, and it can seem overwhelming. But what is not overwhelming is buying a house and then renting it out. They're like, oh, I can do that easy.
Right.
But then I ask you, when you're done doing it, what was your return on hassle? ROH. That's the, how much time, energy did it take to make the $300 a year that you made in profit to go deal with the late night toilets, tenants, and trash problems. But no, wait, JP, I have a third party property manager. Okay. Who's going to manage them? Who makes sure that they're collecting the rents? Who when there's when the roof breaks or there's a hail damage, like there's a threshold and payments they can authorize. Guess who they're going to call? And usually they're going to call you on vacation. So the return on hassle doesn't really make a lot of sense for those sort of things. It's a very common thing that I see people run into. So yes, depending on where you're at, right, as an investor, I like to tell people, and what I'm doing now, focusing exclusively, is on being a passive investor in these deals where you have a well experienced operator doing all the day to day, even though they might have their own property manager or a third party property manager, just so that we're a lot further along and removed, because we want to enjoy the peace and quality of life without having to deal with toilets and trash.
I hate to scale that problem, right? Like that's what I hear when I hear like, okay, we got 700 apartments. It's like, ugh. So that's awesome that you found a way to go around that. It
didn't happen that way. It happened organically through the process of doing this. Yeah, we have a property management company. It's a lot of hard work. There's not a lot of money in it, but we do it because we need to have control over the assets that we run. And that was important. But I mean, my poor Matt handles the operations side, and it's kind of like a thankless job. It's a lot of work, not a lot of benefit there. But for our investors and their peace of mind, we do that. But otherwise, we're not interested in doing it until we're done. We're done, right? But up until then, we don't want to do more of that.
Yeah. Well, JP, you mentioned, obviously you had a long, successful career in tech sales. You're sounds like you're being very successful in your new career in passive investment through real estate. I'd love to hear from you. We have a lot of sales folks in my audience. I'd love to hear from you. Like, what are some lessons that you learned along the way that maybe you wish you knew earlier?
Yeah. So, you mentioned about 401ks and IRAs and, the kind of strategies around that. And I think what I've learned, a couple of things. One, the money that we make, the time we trade for our money in sales is subject to the highest tax rates. Okay, fine. Understanding the game is step number one. Cool. I get that. How do we avoid that? How do we get out of that? Well, you start making your money through alternative means, through capital gains, earn passive income. If you're making, if you're seeing quarterly commission checks where you're able to get 25, 50, 75, 100K or more, instead of putting in the stock market, right, which a lot of sellers that work for a public company or work for a startup, like they're heavily invested and there's a lot of risk there, right? You get RSUs, maybe you work for Cisco or Salesforce or whatever, like you're getting these employee stock benefits. And that's great and all, but then you're going to take your money, pre-tax dollars, going to buy more, 401k money, that more in the stock market. And we're just kind of coming off of this trade war tariff news where there's a lot of volatility in the market. And I don't know about you, but I don't like opening up my Robinhood app and seeing red like daily or getting some alert on there. Like the emotional toll that takes, it sucks. What I like about real estate investing is you don't have these massively dynamic market sentiment changes. So we're trading on emotion right now, and the value of your portfolio went down 15%. It doesn't really work like that. It's a lot more. It's like a cruise ship in the ocean. Like it's not going to change course that quickly, which is also its downside. Like they're usually illiquid investments. You can't just cash out tomorrow if you have a big life event. So there's kind of pros and cons there. So I think recognizing that the stock market and investing in stocks or equities have their place in a portfolio, but also not becoming reliant on that and really trying to find and investing in cash flowing assets that have tax benefits. So a lot of the real estate deals that we do, they have these tax benefits. So you invest in a deal, there's depreciation, there's lots of different things that we can do to make paper losses so that your 100K into a deal on paper is negative 100K. Why? Oh, that's bad. No, it's good because it means you got to like dig out from a hole before you can start paying taxes on the money that you make. And that's what the ultra wealthy have figured out. That's why they've been doing this with family offices and private equity groups for many, many years, for decades. It's just sort of getting out now that this is what they've been doing.
Right on. Well, I liked one of the things. I was just reading one of your posts here recently, and I like one of the things that you pointed out. It's very Kiyosaki-esque of assets versus liabilities. So I like the idea of when you get that paycheck, so many things that we buy are liabilities and not assets. Your car, that's a liability. Like that car just costs you more.
And you need it, but yes, it is an absolute liability.
Yeah, you don't need a Ferrari, like the 40-year-old Geo will get you to work too, right? Maybe cost you more in the long run, but what is truly an asset versus liability? And it's interesting to me that you even call your home. You mentioned your house. That's a liability because that's something that you have to upkeep. It keeps costing you more. Whereas I think a lot of people look at their house and they're like, this is the greatest asset that I have.
Yes.
Yeah.
I think, and this is a relatively recent realization for me. All right. I'm of the opinion now that liabilities are things that cost you money, period. and assets are only things that actually give you cash flow, period. That is the simplest way that you can look at the world, right? The thing that you're buying, is it going to cost me money each month? Yes or no? Boat, RV, house, my best investment, right? My house is going to cost you. Yes, it is a liability, period. Is this thing I'm going to buy actually going to spit out cash flow? Real estate investment. Is it a royalty? Is it a dividend? Is it a stock? Okay, cool. That's an asset. And so when you understand those fundamental things, the next way to apply that is, okay, well, I want to buy a liability. I want to buy this house. I want to buy this car. I want to buy the Ferrari. How do I do that? You ask yourself, what asset can I buy that will spit out the cash flow to now pay for this liability? That's the powerful shift, because then you're not working to pay for the liability. You're paying for this cash spitting out cash machine asset that's, yes, paying for your liability. And when you're done with that liability, it's still spitting out cash flow, and you can use that for something else. And that's what you can use to sustain living and surviving your life, so that you can become so rich you can quit your job and not feel like you're tied to your quota or your all of the things that us sellers are obligated towards. We're getting that, end of year pressure or end of quarter pressure because we have to perform, because we have a lifestyle that we've built that is highly dependent on our ability to feed the machine. I speak from experience.
Yeah. Well, I know that so many of us feel that pressure, and I think that's part of it as well. Like, not just the lifestyle, but you mentioned, why do we want to be so rich that we can quit? Well, there's a lot of pressure that goes into that, into performing at that level. And I always think of the Warren Buffett. I tell my kids this, and my son is 11, and he knows this quite well. Like, until you can find a way to make money in your sleep, you will work until the day you die, right?
Yep.
And I just feel that. I'm like, man, I don't want to do that. And finding a way to do that, not just make more money, but also be taxed less in the process. So with this method, are you actually able to get down to like no tax, like zero?
Yeah, we can talk about that. So there's a couple of things. First, before I get into that, I'll say there's this approach. There's a handful of really good benefits, right? And sometimes you say passive income, and it shoots right by real fast. Passive income, no QBRs, no demos, no sales calls. It doesn't require you to do a thing. So let that sink in. Then the money that you make that way, passively while you're sleeping and on vacation, it's taxed at a lower rate, up to half of what you're currently paying right now. And there's different tax strategies that you can apply, or your CPA can apply, to shelter that further, right? So there's things like cost segregation studies, there's depreciation, there's 1031 exchanges, there's a whole bunch of and there's even more. There's 30 or 40 different things that you could do to mitigate or minimize the amount of tax you pay. The other thing you could do that's kind of advanced, I talk about in the book, is becoming a real estate professional in the eyes of the IRS. And what that allows you to do is the following. So imagine you're making $1 million a year in sales, okay? Crushing it by all means. Working 80 hours a week, making $1 million a year. You're paying, what's the number? You're paying about $300 and something thousand, $400,000 or so on taxes of that. Okay, now what if you also invested $1 million in real estate that same year, just for argument's sake, okay? $1 million came in, $1 million went out. Now with the real estate, depending on when you invested, there was a time, it's been stepped down, but there was a time where if you did a special study, it's called a cost segregation study. Basically, an engineer goes to the property and looks at all of the different components of the property, like the roof, the age of the doors, the windows, all the pieces, and it builds a very granular schedule of depreciation. And what that does is it brings in, instead of 30 years, you could bring it into 5 years or 2 years or 1 year. And the impact of that is sometimes you can write off your entire investment. So I'll give an example. I had a deal that I invested in. I think I put like 100 grand in there. I was able to write off 114% of that as a loss. So on my tax documents, I had a negative $114,000 basis. So it meant that I had to earn at least $114,000 of income from that investment before I paid a cent on the first dollar, or pay taxes on the first dollar that came out of that. So it puts you at a great, disposition, if you will, for tax purposes. That's the law has changed a little bit, and it might come back with Trump in office there. But by being a real estate professional, what I can do is that $114,000 loss, or the 114% of my $1 million loss, I could write off against my active income. That's the special thing that you can only do if you are a real estate professional in the eyes of the IRS. It means you have to work more full-time in real estate and have a portfolio. There's a bunch of check hoops you got to jump through. Not everyone can do it, but your spouse can do it potentially. And then they can qualify for it. And that would potentially allow you to do that. Now, of course, talk with a tax attorney, talk with your CPA. I don't pretend to be one. I just had to learn all this stuff to be able to try to describe it to people. But that is a way that a lot of the ultra wealthy are able to legally use the system for what it's worth, right? To not have to pay taxes, or very, very little. You can even defer and push off any profits you made from a sale and buy another property. So you buy a 12 unit, right? Hold it for a couple of years. And you're like, you know what? I made $1 million in profits. I'm going to go buy a 30 unit, and you go roll it into that one. You don't pay taxes on it. You keep going, and you can keep rolling into perpetuity if you want to. And you can take out tax-free loans on the property. There's a whole bunch of stuff that you can do that you can't do with the stock market. I can keep going on, Royce, but I think you get the gist.
Yeah, I love that. That's super cool, and I like that. You mentioned tax shelters and whatnot. We're not talking about Swiss bank accounts. We're not going to see you in an orange jumpsuit on the side of the road next week. No. These are all legal things that.
Let me get to that real quick. Not the orange jumpsuit, but the tax system is built to incentivize private money into real estate investing and starting businesses. Period. It is not meant to incentivize people to go work and make lots of money, like in a job as an employee. It is meant to inspire people to go out and create housing for the public. And as a result, the tax code has all of these benefits for people that do that, and they afford them these benefits. So if you look at the tax code and you see all these tax benefits for real estate, it's on purpose. It's for a reason. So, blaming the rich for your problems is not the solution to the problem here. It's being ignorant of the rules and learning how to play the game.
Why is that, if I can ask? I think of there's been a lot of talk about Gen Z, and it's we rent rather than buy housing. That's the new model. We don't need that. I could just go be a tech startup founder, and doesn't the government want me to do that? Why, in your opinion, then, is the tax so transparently leaning towards housing? Yeah,
because we have an affordable housing crisis in America. There is a website. The name escapes me. It's weareapartments.com.org. It was created by the Association of Apartment Owners to showcase how much housing demand there is in the top cities in the country. And this is kind of a universal thing that's been going on for many, many years. That's why HUD exists, to make housing more affordable for first-time renters. Because having affordable housing, number one, is a problem in the U.S., especially in certain cities, locations where there's a lot of population growth. Population growth is a result usually of job growth. People want to go where the jobs are, right? Sure. And there just isn't enough supply to support the demand. Now, the last couple of years with all the interest rates nonsense that we went through, that put a lot of new construction on pause or on hold. So you're going to see, because these things that take 3 years to kind of build up, there is none in the pipeline. You're going to see this kind of housing crisis in a lot of different cities, which will mean rent and housing prices will remain high because there isn't new product in the marketplace there. But the simple answer to your very good question is it comes down to having access to affordable housing. And when I say affordable, I don't mean Section 8 or things with government vouchers. I just mean workforce housing for the gym teachers and the police officers and the village people of America, basically.
Right on. Well, JP, thanks so much for joining me today. If somebody wants to work with you, again, go ahead and give me that again. Obviously, we can buy your book on Amazon, but how do we find you? How do we?
You could, if you wanted to pay more money. You're better off just getting it on jpalbano.com/gift to get it for free. just cover shipping and handling. And I also throw in some free bonuses with that too. So you can't get that from Amazon. But yeah, jpalbano.com is the way to do it. If you want information about joining my investor club, it's very simple. It's techsalesinvestorclub.com.
Very good. And you're giving that book away for free. So, we have to pay for shipping. So that means even your book is tax-free.
It is actually, yes. It is.
Right on. Well, thanks again for joining me today. I appreciate it.
Of course. I appreciate the opportunity. Thank you so much, Royce.